So we're going to be looking at theme 2.1, sources of finance for business growth. Last lesson we looked at the actual business growth part, where we looked at organic and inorganic growth, the different types there. Today we're going to look at how businesses can fund that, how they can finance the growth of the business. We're going to look at 4 sources of finance. We're going to look at loan capital, retained profit, selling assets, and share capital. So from these 4, the first task is obviously, as we did in the previous lesson, to give an explanation and a potential example of what it means to take or what you could use that source of finance for. Okay, so you've got loan capital. This is a way of a business getting large amounts of money. They can go to a bank to get a large loan if they need to. That could be for a number of reasons. It could be for starting up a new business in a new location with a new premises. That could be in the form of a mortgage. It could be a medium-term loan in the form of buying a van or whatever it might be for deliveries. So loan capital is a way of getting large amounts of money from the bank, of course, if they approve it straight away. Retained profit. Now, retained profit is money that a business has made, obviously minus all their costs. Therefore, it's profit, sales revenue minus costs, in the previous year. And they, instead of investing that money in themselves, well, they could have bought a nice holiday or a new car, they would have invested it back into the business. And that is retained profit. Money that is earned last year in terms of profit, once all the costs have been taken into consideration, they've still got money left over. They've actually now retained the profit and they're investing it back in the business, whether that is to, again, expand in terms of buying a new shop, developing a website, whatever it may be. Selling assets. So if you're, for example, a EasyJet or any type of plane company like that, they may have planes that they can sell off. They can sell that asset. Asset is something that you own. So as a result, there's no point in leaving the plane parked in the airport. You may as well sell that asset and get money back for it. That's what selling assets is. And that is another way. Old equipment, old machinery is another example. Share capital is essentially when a public limited company, a PLC, sells shares to the general public to raise money. So therefore, the business, such as EasyJet, we're on EasyJet, we may as well use them again, can sell parts of their shares to the general public via the London Stock Exchange or FTSE 100, whatever it may be, to then generate income for growth if they want to buy new planes or if they whatever they might want to do. So they are the 4 types of sources of finance. I'm going to pause it now in a second. I would like you to think of one advantage and one disadvantage for loan capital, retained profit, selling assets, and share capital. Okay, so an advantage of loan capital, of course, is you can you will know exactly what you're paying back every single month. So what you can do is you can set an amount and agree it with the bank. If it's £10,000, I don't know, for buying a new delivery van, 20,000, whatever it may be. As a business, you can look at your repayment schedule afterwards and know what you're paying back. So, and you get the money pretty much guaranteed straight away in your bank if you're approved. So it's a really, and you can start earning money on that asset as well. So for example, you're going to make money delivering pizzas if you're a pizza company. So it's really important that if you are going to get a loan, you can, and the bank will do this for you as well, but to check that you can make your repayments after. Of course, that could be a disadvantage. The disadvantage is you are creating a debt for yourself. So if, for example, you do buy a delivery van and for whatever reason that is not successful, you may not earn the money from that van, but you'll still have the debt to pay off. So that can be a disadvantage. Retained profit, an advantage of retained profit is you don't have to pay any money back because it's there already. You have earned that money, that is yours, and you're using that to grow. Of course, a disadvantage to retain profit, you're using all of the money straight away, and there may be pressures for you to make a profit, because if you, for example, have shareholders, or you have people invested in your business, they might want, well, I don't want you to use it to grow the business. I want a larger percentage of what I've earned. So they might have to agree as well. So that can be a sticking point sometimes. Selling assets, it frees up capital, of course, for reinvestment. Pretty much the main advantage to that. Disadvantage is, of course, if you're selling an asset and it's secondhand, you're not really going to get a lot of money for it. It's like selling a secondhand car, I suppose. You're not going to get the money you paid for it, so you will lose money. And if you're growing a business, are you likely to have any assets? Probably not. So again, this is another disadvantage. You may have some assets, but it's not going to generate a large amount of money. Now, share capital, of course, as a public limited company, you can get income from the general public by selling your stocks on the stock exchange, for example. An advantage to that is, of course, you can access large sums of money. The main disadvantage is you dilute your your ownership share. So obviously, the disadvantage is you're giving up part of your business to generate income for growth. However, it could be an advantage, because if you want to grow your business exponentially, whatever way that is, it could actually generate more money. So what I'd like you to do then is I'd like you to make sure that this has been completed. You don't just have to listen to what I've said. You can do your own research as well. You can have a look at what information you can look at examples. You can put advantages, disadvantages. One little challenge task, just to finish, what I'd like you to do is I'd like you to identify which of those 4 sources of finance are internal and which are external. Now, there's 2 internal and 2 external. There's a clue for you. Could you just write internal and then a list, external and a list, and send that to me via email? Thank you very much.